We're continuing our coverage here from Davos, and joining me now is Tyagarajan from Genpact. Tiger, thanks very much for joining us here in Davos. The mood here is one of caution and pessimism. Offshore Insights has just put out its report on the outlook for 2019, and for the IT services sector, they say 2019 is at best dull or flattish. What's your own take?
Well, that is probably true, but dull or flat in today's world may not be a bad thing, given that 18 was not really bad. Plus, given the volatility in the world and the somberness, as you described it, dull and flat, but I think there's going to be differentiation. Some will not be dull and flat, some will really do well.
What is going to do really well?
I think within the firms, those who are getting into the new world, into digital, into leveraging new technologies, into leveraging AI, machine learning, are probably going to do better. Those who have a culture to drive that. So I'm a big believer that culture is what defines most of these changes.
But since you're talking about the digital transformation and how that will continue to be a lever and separate the men from the boys, so to speak, give me a sense of what's happening within Genpact at this point in time in terms of the revenue breakup.
So 22% of our revenue is now digital transformation, and that's growing at 25%. The whole firm is growing at about 14-15% constant currency, so that sets us up very nicely. The bigger issue is that when we deal with customers, they're all really keen to drive change using digital. And that's where they need partners. They can't do it themselves. The other thing that we're finding is people want to do things faster than before. They want to drive bigger change. They want to take more risks.
Does that also mean bigger deals? Because that's something that we saw in 2018.
The last 60 days, we announced a big deal with Bridgewater. It's public. We announced a big deal with Walmart. We announced a big deal with GE, 3 big deals. And we are on the verge of announcing a couple of more. So in the era of big deals for us is very, very real.
So when we talk about big deals and you talk about how people want to move faster and move at scale, what is it going to mean both in terms of deal value and then for margins as well?
So deal value clearly is bigger, but we must understand when we talk about deal value, no longer is it only about labor. It's about labor and technology and digital platforms. And 2, that deal value, one of the objectives is to use digital to actually reduce the amount of work and to make it more machine and man plus machine together. What does it do to margins? Over time, margins should increase because you have more technology component.
How much more?
I don't know. Shireen, $1 million question. But right now, I think the whole industry is focused on traversing the bridge to the new world, helping clients traverse that bridge. So it's not necessarily focused on only margins. I think it'll be dangerous to only focus on margins.
Since you're talking about traversing new trajectory, you've done a bunch of acquisitions, and these have largely been sort of tuck-in acquisitions. Yes. But can we now expect big acquisitions on your part to try and pivot the company to a different scale? I
think we've pivoted the company, Shireen, in the last 4 years dramatically using these tuck-in acquisitions. We've done 9 of them. So when you put all the 9 acquisitions together, they turn out to be pretty significant transformation. I'll give you one interesting tidbit. In the top 500 leaders of the company, 50 leaders have come in through acquisitions, and they now have a portfolio that is different from what they had. We couldn't have got that except for the fact that they came in with that strength, whether it's AI, machine learning, design thinking, deep sourcing and supply chain capabilities and so on. So I'm not so sure it is necessary to do a large deal to make it transformational.
Okay. The reason I asked that is because there is talk of a lot of mid-cap IT companies in India being on the block. Yeah. Would that be something that you would want to consider?
We've looked at those over the last 15 years. We've never found a good match for mid-cap IT companies to where we are going. Where we are going is new tech. Where we are going is new AI machine learning kind of technology, integrating it with our services. So, and bringing in consulting and that kind of thinking. I'm not so sure that it's easy to understand how a mid-cap IT company, an IT services company would integrate with someone like that.
So you're not looking at anything?
Well, I wouldn't say that. We keep looking. It's always good to look.
But it doesn't look very exciting.
Or
strategically it doesn't fit.
You always find the one diamond in a massive mine, and that's your home run. But
anything close to having been found on the radar? So
no, nothing that I can talk about right now. No.
What's the outlook as far as the US is concerned? Because you've been ramping up hiring there. We saw a tweet from President Trump on the H-1B visas, which seemed to give some hope about possibly better regulation in the making. NASSCOM thinks it's status quo, though. But what's your own take?
So first of all, I'll say about our business, we're not very dependent on H-1B visas because we have operating groups in 9 operating centers in the US, and those have been ramping up. Those have been ramping up actually driven less by the political and regulatory environment. It's more because of the kind of work we are doing. When we do work that's very close to the customer, so for example, for Walmart, we actually are doing work in Bentonville. It can't be done anywhere else. So yes, we are ramping up in the US. H-1B visa doesn't impact us much. Perspective on what's going to happen in the future, well, unemployment is at a historical low.
Yeah.
So I'm not so sure. So yeah, H-1B rhetoric seems to be better today than yesterday.
Okay. In terms of debt as well as capital allocation, there are some concerns on the debt that you've taken on. What's the sense in terms of the repayment plan now?
So we have a very significant cash flow strength in our business. That's the nature of our business. And the debt we have on our books is broadly about 2 times net debt to EBITDA, which is kind of what we've said we will be at. And that's where we are at. So whether it's, and we have both the rating agencies fine with that approach. Our cash flow profile is very, very strong in the business.
And capital allocation, higher dividends perhaps?
Well, we started dividends just a year plus back. And dividends is a question of being steady and sustained over a long period of time. I'm not so sure whether necessarily jumping up high dividends is the nature of our business. Our business is really about investing in organic growth, investing in acquisitions, and then dividend, of course. And then if there's leftover stuff, then we won't keep it on our balance sheet. We'll use it for buyback and so on.
Mm-hmm. So 2019, key triggers that will drive Genpact.
I would say execution of a number of the large deals we have won, continuing the pivot on digital, continuing to find a way to leverage all those technologies into our services. And then we have launched a pretty significant program across the company called Genome, which is really reskilling 80,000 people, starting with reskilling 5,000 people at the mid-management level, and then on to 80,000 people. And when I say reskilling, this is interesting. It is actually using AI to reskill. So the same technology that people think is going to cause the problem is the technology that one should use to actually improve training. And that's saying, I customize training exactly for you, and it's 10 minutes of this and 15 minutes of that and 30 minutes of this, and you get certified, and then you can do new jobs.
My final question, you're moderating a session here on AI and the world with AI and ML, etc. And you just talked about how AI can help with reskilling, but what is it going to mean in terms of net job additions? Because that's the key concern.
So Shireen, I'm an eternal optimist. I'm a big believer that in the end, net jobs will get created. I mean, you look at any technology, it first changes jobs, and therefore it hurts, and then it creates new jobs that you can't even imagine. So it's going to happen. The transition is going to be painful. There are pockets that will lose jobs that don't create jobs. There are other pockets that will gain. So countries will gain and lose. Companies will gain and lose. Individuals will gain and lose. I think the best advice that I would give anyone, whether it's a firm or a country or an individual, is you have to be flexible. And irrespective of how much gray hair you have to learn. You have to keep learning.
Well, we hope you continue to keep learning. Tiger, always a pleasure. Many thanks for joining us here in Davos on CNBC TV 18.
And I'm joined now by a guest who has quite a significant interest in what's happening in the U.S. I'm delighted to say I'm joined by Salil Parekh, who is CEO and MD of Infosys. Salil, pleasure to have you here on the show.
Thank you.
And the reason I said that is because you have enjoyed quite a boost in business from the U.S. in recent years. Have you seen any impact from this shutdown?
Well, thanks first for having me here, Nancy. So far, we've actually not seen any impact on our business. About 60% of our business comes from the U.S. And we've had good growth. We announced our results just a few days ago for the last quarter. Strong growth in the U.S., strong growth in financial services across all of the sectors. Of course, the work that's going on within the U.S. and the concern with the slowdown, with the shutdown, will result in some impact downstream if it's not addressed at one stage.
And perhaps the concern is it's coming at a time where it's late-stage growth in the United States. People are worried that perhaps there won't be an infrastructure plan because of the stalemate in Washington. As it pertains to your business going forward, are you already seeing any waning confidence from U.S. corporates, any dip in demand for your business services?
You know, again, we've not seen any dip in demand. Of course, this has been a long growth cycle. With the shutdown and with some other activities globally, there's some concern that this could start to slow down. There's talk about it, but in real demand terms, there's no real impact.
Is that true globally for your business as well?
Also, so our European business actually grew faster than our US business in the last quarter, and that's going well. Asia Pacific for us, mainly Australia and Japan, that also grew nicely.
Okay.
So all of those at this stage seem to be okay.
Yeah, we were talking about this PwC survey about pessimism out there, talking about the IMF downgrades. Do you think there is a disconnect between the real fundamentals there and the sentiment?
It's difficult to say because in many ways the view is because it's gone on for so long, the expansion, it should come to some slowing.
Yeah.
But when you talk to people, and especially on digital investments, we still see massive growth. We had 30% growth in digital. And so that's not something that's going to quickly disappear to zero in the coming years.
Tell me a bit more about what's happening in your home market, because also part of that PwC survey, they really mentioned that India was seen as a rising star for global companies looking for investment outside of their own countries. Have you been encouraged by the developments there? Any reason to be worried about a pair back in reforms as we get closer to elections?
Well, I think the good news with the domestic market in India is the growth's been sustained over the last several years. And at 7.4 to 7.8%, that's a strong growth on a fairly large economy now. The changes that are being put in place are all starting to support the growth, especially the GST, the goods and services tax we've had. Of course, the elections in the near future, but we don't see any change in the way the government is approaching business. If anything, there'll be more focus on making sure the business grows. And with the elections quickly done, I think the growth will continue on.
How are things at the company in terms of morale? Because it was a very public feud between the former CEO, the founders, and that was made quite well known by people. Are you confident? Do you feel better about morale today and the level of attrition?
But what we see now is we've got a real focus with our clients in the market. With that focus, clients are starting to see that we are more relevant for them. And that's calmed everyone down within the company. So we've got good traction with clients, a lot of investment in digital, and big move in reskilling our people. All of those things are helping to calm things down.
Here from Davos, and joining us now is the India Business Leader of the Year, Sajjan Jindal. Thanks very much for joining us here, Mr. Jindal. Let me start by asking you about the overall outlook as far as each of your businesses are concerned. I mean, you've gone through boom and bust cycles. The mood here in Davos today is one of pessimism and caution, though the mood in India is different in comparison to what we're seeing globally. What's the broad outlook for you?
I think if we talk about the industries that I am involved with, steel, cement, power and infrastructure, India is a growth story. It's continuing to grow, though we are heading into the election time, and but still India remains quite robust. Global, there are headwinds, whether our exports are concerned because of the global trade situation, China getting affected by the US, and European Union also is looking to protect their own market. So there is a lot of global headwinds, and the world is quite a dynamic place, and at the moment, a lot of changes are taking place in the world. But India remains I'm quite positive on India.
You know, you talked about protection across the world, but the Indian steel industry has also been asking for protection. We've seen measures being taken, but more is the demand of Indian steel makers. What exactly are you looking for?
You know, the problem with steel industry is that the product, the material can flow in any direction because the cost of transportation is minimal. Therefore, every country in the world, if you look at United States or look at Europe or European Union, look at Japan, Korea, China, Brazil, every country tries to protect their own home market because steel is very strategic to the country, because you cannot rely on imported steel for everything. You need to produce your own steel, and India is a large country. So therefore, we as an industry, we always want that our industry there should be a fair competition. Their imports are coming, for example, today, Japan and Korea, they don't allow any imports. They have non-tariff barriers, huge amount of non-tariff barriers. But we have FTA with Japan and Korea, and a lot
So you want safeguard duties on countries where we have an FTA?
FTA, because a lot of steel comes from Japan and Korea into India at 0% duty, so which is not fair to the Indian steel industry.
Okay. I asked you about the outlook, but what does that mean in terms of investments across each of your businesses? What can we expect?
So I'm fairly bullish on India, as I said earlier, and we continue to invest in India. I'm a great believer in India's story, and I believe that India will continue to grow, continue to expand. And
so what kind of expansion plans have you lined up?
For example, our steel business is today 18 million tons. We have 2 plants coming up, each of 5 million tons. First one will get completed by in the next fiscal, and the next one will get over in the next year after fiscal. So therefore, we will have 10 million tons coming up. Plus, we have some inorganic growth through the IBC process, where we are participating in acquiring some assets. So therefore, we are looking that by 2025, we should be organically, we should get to a 40 million ton capacity in steel. And inorganically, if we add up, maybe close to 50 million tons, which is a significant capacity.
IPO for the cement business, because that has been something that you've been considering for a while, but are we likely to see that go through?
Yeah, I mean, we need to get to a critical capacity before we really do the IPO. So probably 2-3 years down the road.
And is an inorganic strategy the route to be able to get to that critical capacity in the cement business as well?
We are open to those ideas as well, to get to that capacity. Even, I mean, organically we'll get there in 2 years, but if we can add capacities through inorganic routes, that's.
Are you actively looking at anything?
Not very actively. I mean, there are opportunities which are on the drawing board, on the horizon, but we haven't yet got the value.
It's just a valuation issue?
It's, valuation, market, quality.
Your presence is largely in the south and the west.
South and the west, yeah. Now we have 2 plants in the east as well. We don't have anything in the north, and we are seriously looking at if something we can acquire in the north to become pan-India.
You know, you talked about the IBC process, and one matter is sub judice. The other is also sub judice, but of course we don't know what the outcome will be. This battle for SR Steel, what's your take on how that's going to play out?
No, I mean, SR Steel is a big steel company at about 10 million ton nearly. So it's a very significant play, and ArcelorMittal is very seriously looking at it. I mean, at the moment they are the highest bidder, and they are most likely to get to the victory line. But there's a lot of.
Why did you decide to throw your hat into the ring?
We haven't. I mean, we were at one time we were looking at Bhushan Steel very keenly, and therefore we did not participate in SR because we thought that Bhushan Steel was a better asset, which we lost to Tata Steel. And so thereafter we started becoming a little more interested in SR to look at whether there was a way to consolidate that industry, because Tata Steel is consolidating in the east, and whether we could consolidate in the west. So that's the idea. I mean, I'm not sure whether I will be able to do that, but because ArcelorMittal is there with the highest bidder, but because of various litigations, let's see what happens.
Any other specific stressed assets that you would be interested in across these sectors?
I mean, in steel, we don't see any more assets left, because others are all very small and don't have the critical mass for us to take interest. We have, as I said, big plans to grow organically. So therefore, we are not looking at other than Bhushan Power and Steel and SR Steel.
You know, this diversification into the paints business or into the electric vehicle space, is that something that you seriously wanted to do, or is that something that Parth wanted to do and you've decided to support his decision?
So cement and paint is Parth's area of activity. He enjoys that. He likes to get into business which has higher market multiples, as well as which is a B2C business. My main focus has been on B2B business and more commodity businesses. But this auto has been I've been very keen to get into auto business for a long time. But
why?
I don't know, probably childhood dream or something that I wanted to make a car, but there were so many people in the world doing it, and everybody.
Even Tesla is struggling with his electric vehicles.
I know. But I never get worried about the struggle, because I enjoy struggle, and I always look for trouble. That's been my DNA.
But it's also gotten you into trouble.
It has. Because if you look for trouble, you will get into trouble. So I have always looked for trouble, and probably my father also was like that. He always got into areas which were very difficult and which created, but he would also take chances, and that's what he enjoyed. If things would work well, he would go to the plant and he'd say, okay, stop this. I want to make a complete change. And we would get very upset that why you are doing that. But he said, no, I'm not enjoying it anymore. It's working too smoothly.
But can you make those bets today? I mean, you've gone through a CDR process, for instance, in the past, and there is erosion of wealth and value. Can you make those kinds of bets today?
No, why not? I mean, you see, I'm not going to do any erosion of wealth in my steel business. That's a business which is working well and which is doing well. So it's on an auto mode. My involvement in that is not too much. I mean, I'm leading it, but I'm more like a chairman and providing the leadership at that level. But in auto, I feel that that's something where I want to have fun, and I want to enjoy that.
So what kind of investments are we talking about? And have you tied up with? There's a lot of talk around you tying up with Chinese manufacturers, etc.
No.
What's the story?
No. Chinese, we looked at because China is very big on EV, and Tesla kind of stuff cannot work in India. It's too expensive. It's too high tech. So Chinese EV is a very good model for India. So we looked at all those cars, and most of every Chinese company wanted to tie up with us. But we are not looking at Chinese because to sell a Chinese product in India is going to be a very difficult thing. And last coming from a JSW saddle. So therefore we did not. So we are looking at a German concept, and technology would come from Germany and or Austria, and that we would be doing it 100% JSW.
And manufacturing in India?
Of course, 100%.
Okay. So what is going to be the positioning of this electric vehicle, and when do we actually see it being commercialized? Because, even companies like Mahindra, who've had the first mover advantage, continue to struggle in the Indian market.
No, I think there is still time for the electric vehicle to come into India, and because we don't have the infrastructure, still the technology is still developing. Because when you come with the product, it must match the IC engine technology. It must have that same acceleration. It must
and range.
And range. Yeah. So that's why. So we believe that in 2 to 3 years, the batteries will become very cheap, and the range will increase a lot. And I don't really worry about the infrastructure, because India, I always believe that India is a very, very different kind of a country, where the infrastructure will come as the product gets launched. For example, the aircrafts came before the airports were built in India, in the sense that, and today we see Bombay, we are roaming around for half an hour congestion. So now new airport is being expedited, and new highways are being built. So that would happen.
So this is a serious plan.
No, absolutely serious. It will happen.
How much money are you putting?
Money in excess of $1 billion.
In excess of $1 billion. And are you also looking at getting into the battery space?
So battery, we are not directly looking at it because it's again a very technology-driven product, and the technology is moving very fast in battery. As I said, the batteries are becoming cheaper, and it's becoming a commodity, and the range is increasing. It's becoming lighter. So there's a lot of research is going on in the battery field. So we don't want to get into that. That's being done by the Americans, the Europeans, and the Koreans and the Japanese in a big way.
So where will the $1 billion come from?
So that we will find somewhere.
You'll find somewhere. Okay. So let me end then by asking you, as you look forward to the next 5 years, the group is trying to reposition itself from a brand perspective as well. And of course, while you're consolidating your existing businesses, you're looking at new areas. What will be the priority that will lead the group?
No, I think clearly steel remains our mainstay. I have great faith in steel business, because I believe it's the best material on earth, and so therefore we will continue to grow this business. We want to be in some position in the world ranking in the steel business, not only from a capacity point of view, but also from a point of view of profitability. We want to be the most profitable steel company in the world. and I think we, being in India and being JSW, we can be there.
So just a quick final question on the EV business. Is this going to be a subsidiary of JSW that will run the operations? How will it work?
It would be a subsidiary of not JSW Steel, but maybe of JSW Energy.
Of JSW Energy. By when can we expect this to sort of take off?
So we are very seriously working on it. I can't say that whether the car would be on road in 2 years or 3 years or 4 years, but we are really working. We have a very phenomenal team, a team of youngsters from IITs and engineering colleges, and we are all working very diligently to see that in next 3 years we have a very nice product on the road.
Next 3 years, a nice EV product on the road from the Jindal stable. Sajjan Jindal, always a pleasure. Appreciate you joining us here in Davos. Thanks very much for your time. Wish you all the very best. Well, with that, it is time for us to wrap up this special from all of us here. Goodbye. Thanks for watching.